And the message from the longer historical experience is it's never easy. My wife Carmen and Ken Rogoff and I looked at 22 advanced economies since the Napoleonic War and asked what happens when they get their gross debt to more than 90% of the GDP. And we found 4 things. Number 1 is those episodes are very rare. Only 26 episodes of gross public debt on a sustained basis more than 90% across 22 countries, 210 years worth of data. They're rare. They're also long. The median duration of a debt overhang was 23 years. So we don't often get in there, and when you get in there, you get trapped for a long time. Third, they're costly. Real GDP growth is 1.2% slower per year for countries in a debt overhang episode relative to their own history. Combine the second and third observation, long and costly. In the median debt overhang episode, the level of GDP per capita is a quarter lower when you get out as if you had never gotten in. And then lastly, it's not always about higher interest rates. 11 out of 26 cases, real rates are not higher. What happens? Why do you have that quarter lower level of GDP per capita in the median experience after a debt overhang? One is you're less resilient as a macro stabilizer. The amazing thing in the UK, the amazing thing in the United States is how much we're talking about fiscal consolidation even though the unemployment rate's still high, because we're burdened by debt. Second, we don't take advantage of positive net present value projects. Rebuilding efforts after Hurricane Sandy have been blocked because of concerns about public debt. Ask yourself how much more would have been the rebuilding efforts after the tsunami in Japan if gross public debt in Japan wasn't 220% of nominal GDP. Lastly, we probably grow more slowly because we resort to inefficient taxes. And the main focus of this panel is a particularly inefficient and opaque tax that governments often resort to when they're burdened by debt. That's financial repression. What do I mean by that? Well, if public debt in many advanced economies is unsustainable, then we have to invoke Stein's law. And what Herb Stein said is if something is unsustainable, it stops. The debt sustainability condition really only has 4 moving parts. On the top is the level of public debt right now, multiplied into expected future debt creation, that is budget deficits. On the bottom, real growth and the cost of borrowing. Current stock of debt, that's all about default. Current future debt creation, that's about political willingness to rein in the budget. Growth is very difficult in a period of fiscal consolidation, generally goes the wrong way. And so in fact, the most attractive moving part for politicians in a period of high debt loads is to try to lower the cost of borrowing. Governments often work on the cost of borrowing. In half the years in the United States from 1946 to 1979, the real Treasury bill rate was negative. You can work down your stock of debt if you are in fact paying a negative real return. And in fact, in the advanced economies in the post-war period, 5 major advanced economies, they manage something on the order of 1.5 to 5 percentage points worth of GDP reduction in debt per year because of negative rates. How do you do that? Well, you tilt the playing field toward government securities and you engineer modest inflation. How do you tilt the playing field toward government securities? You require higher capital of financial intermediaries. You require higher liquidity buffers. You impose higher reserve requirements. You use stamp taxes, duty taxes, a Tobin tax, a transaction tax, whatever you call. You put in place prudent person rules that encourage ownership of longer-term risk-free securities. You increase the relative importance of ratings in your regulations and in accounting rules. And then lastly, you slow up the velocity of collateral in the financing market so people have to hold more on average. All those things are modest ways of encouraging a greater ownership of what a government is producing a lot of, government securities. Now, recognize that these are prudential policies and particularly attractive after a financial crisis. I'm not a conspiracy theorist. No finance minister will ever have a press conference and announce, today we've decided to repress domestic savers. But they might have a press conference in which they have the prudential regulators on both sides and say, we're going to make absolutely sure that the custodians of your saving are safer. What happened will never happen again. And the way they'll be safer is they'll hold more of the safe assets that we create. Prudential regulators always are charged with protecting the safety net, protecting the insurance funds. They're always going to be pushing for greater ownership of riskless assets on intermediaries' balance sheet, a greater weighting of those assets on their balance sheet, a greater relative importance in terms of market margining and the like. It just so happens when the finance ministers also have a lot of that to sell, there's a better alignment of interests. The ingredients for successful financial repression really require three actors to play their role. First, the government really shouldn't have to fund that much on an ongoing basis, because the more you have to fund, the more potential upward pressure there could be on your interest rates. That requires lower deficits into surpluses and a long maturity of government debt. The public should be somewhat tolerant of restrictions on finance. And third, the central bank should generate a little inflation. Those three things reinforce themselves and are seen most clearly in an episode of successful financial repression. Consider the United States directly after World War II. Directly after World War II, the federal budget went into surplus. The maturity of the public debt was long. So the US government was not selling many securities auction by auction. The public came out of World War II used to controls. Controls on capital, controls on what you could own, controls on prices, controls on rent. And so we're somewhat tolerant of the restrictions on finance in the beginning of the Bretton Woods period. And the Federal Reserve generated only a little bit of inflation in the neighborhood of 1% to 2%, which again was sufficient to make real interest rates negative most years of the 50s and into the 60s. Less successful financial repression was what followed from the 46 to 67 period, 68 to 79. The US federal government began to run budget deficits, had shortened the maturity of its obligations, was rolling over securities. The Federal Reserve relied a little bit more on inflation, and that made the public less and less tolerant on the financial restrictions that were delivering bigger and bigger negative real returns. The financial repression was unsuccessful because inflation eroded the base of the inflation tax, increasingly so. And the process spiraled downward until we got Paul Volcker. Now, in the financial environment, the features of financial repression is low, often negative real short-term interest rates. That's the cost of borrowing, and the goal is to keep it low. Less finance and relatively more costly finance. If you're tilting the playing field toward public securities, private securities are disadvantaged. Credit's safe. Costs of borrowing are real short rates low. The equity premium tends to be high, but those relative returns aren't very attractive because the base, the riskless rate, turns out to be very low. At this juncture, I think you should recognize the alignment of interest across the advanced and emerging market world. Think about what happens at a G20 meeting. Representatives of the advanced economies who attend have a lot of debt to sell, and are therefore more tolerant of controls on capital if those controls on capital make what they have to sell more attractive. The G20 representatives from emerging market economies are importing expansionary monetary policy from the core. They don't mind controls on capital either, because it'll give them a measure of monetary policy independence. So for the first time in 3 decades, go to the G20 equivalent meeting, and you'll find that representatives of advanced economies for fiscal policy reasons and emerging market economies for monetary policy reasons are more tolerant of financial restrictions. In that environment, it's a prediction of low short rates for a very long time and more complicated finance. You may see attractive returns offshore, but it's going to be harder to know how to get any capital gains back. Finance is going to be more expensive.